Good morning, good morning, good morning. It's Wednesday, which means it's time for What the F Happened, a show where we go live every single week at 9:30. I'm joined by my partner in crime, Mr. Snaggy, down there in Florida. What's happening?
Hey, good morning, Chris. Good morning, everybody. Just getting ready. Nice, sunny, beautiful day out. Getting ready to fly out to Las Vegas tomorrow morning to meet Chris and our team and all of our awesome clients that are attending the experience. Mastermind has been sold out for a couple months now, so super excited to see everybody have some fun, race some cars, see some shows, eat some good food, and do some business. At the end of the day, that's what it's all about, is building those relationships and doing business together. Other than that, I had a little mini hurricane apparently come through my office because one of my trees behind me is down. So man down there, the tree didn't like the indoors and started to die a little bit. So we replanted it. We got it outside, bringing it back to life. So we'll deal with that background of the office later on. But other than that, it's a beautiful day. I'm looking forward to What the F today because there's a lot of what the F is happening going on in the news right now. So we'll get right to it.
All right. We'll probably see Mr. Lazy Cash make an appearance today. He is a favorite on this show. That is, if anyone doesn't know, that is my cat, the office cat. His name is Lazy Cash. But in today's news and this past week's news, there is more than we're going to be able to talk about today. So much information. I've got some really important things to show you, some factual charts that show you where we're headed, what's going on right here, right now, because that's what the F is. It's a show where we rant, we rave, and we will argue some of these points. So I am really excited to be going live on Instagram, YouTube, and Facebook. Thank you all for joining us. You will notice that I did not say TikTok because those bastards at TikTok banned me. I can no longer go live on TikTok until the Chinese owner of that company determines that I can. I don't even know what I said. I said nothing bad about Biden. I mentioned his name and all of a sudden I got banned. So, hey, you all know the truth now. So with that being said, we will be right back after this. All right, we are back live for another episode of What the F Happened, and there is a lot of what the beep happening out there. I mean, we can talk about, we'll talk about one of the breaks in the Russell 2000. I'm going to show you a chart. We're also going to talk about some things that Biden, yes, I said that word. Please don't ban me. I didn't say anything bad. We're going to talk about something he did that I guess maybe was a mistake, maybe it was intentional, but we'll play you a video showing you one of the things he did that I definitely don't think was, I just don't think it was a good idea. We're going to talk a little bit about the Magnificent Seven. Oh, the Magnificent Seven and the impact they're going to have, not just on the markets, but also on your 401k, and on your investments. Stephen, what else do we got in the news? Because I know Alphabet is leading the tech shares lower today because they reported bad earnings or lower than expected earnings. GM came out with strong earnings, but their projections for the future are lower. What are your thoughts on some of the?
Yeah, I mean, GM's an interesting one. I was talking to a client yesterday. Actually, it was on one of our webinars we did last night, and they were saying how they work for an end producer for GM. Or I guess they should say they at the beginning of the supply chain, they create parts for GM, and their orders are way down right now because of the expected production and what GM is expecting. GM's the end product, and so it sounds like they're projecting things to come down because they're not ordering as many parts as they usually do. And we're starting to see this across the board with several different large companies. I mean, just on headline news today, Boeing cut 737 MAX delivery forecast, has production issues, dent third quarter results. It just seems like everywhere you look, just everything's starting to really slow down right now.
Yeah, I mean, you can even, there's been a lot of Jamie Dimon has been in the news a lot lately. And, he's talking about how economic forecasts have been completely wrong. And I think the forecasters, the economists, the researchers, all those folks, they're They're trying to predict where we're going to go. And I've done many shows. We did a show last night talking about this. Where are we going to go? Are we soft landing? Are we going to end up in a recession? Jamie Dimon has been very vocal that we're not going to soft land. He's not the only one. Bank of America execs, we're not going to soft land. CEOs, there was a poll done. 84% of all CEOs running companies across the United States, 84% say we're headed to a recession. Economists say that 48% of all economists say we're headed to a recession, which I think is low because a lot of economists work for the Fed. A lot of economists work for people that don't want them to say that we're headed to a recession. It's just bad for business. But when you really look through and you see the facts, and every day in the news you see this, all companies have been reporting earnings. Now, I also want to come back, from YouTube. We got a bunch of you commenting on YouTube. We got Amphone said the overall market is bullish. Okay, there's bullish and there's bearish. Bearish means that it's looking like it's going down. Bullish is saying it's looking like it's going up. So Amphone, I do want to talk about that because you're right. From the surface, it would appear that it's bullish. But when you go one layer deeper, peel the onion one time, it isn't bullish at all. Matter of fact, sentiment in the market is absolutely bearish. But the markets are portraying the illusion, because that's really what it is, of a bullish market. And if any of you are taking the bullish side of this thing, I think you're going to get hurt really bad. I truly think that. Jamie Dimon thinks that. Ray Dalio thinks that. Grantham thinks that. I mean, we could keep going on. Some legends definitely would say that the bullish look right now is going to get you in trouble. It's not what you should be looking at. You should be looking at the forecast. You should be looking at what's coming, not where we're at. The market might be bullish today or appear to be bullish, because I don't want to say it's bullish at all. It might appear to be bullish, but the future outlook from all the companies reporting earnings, good, bad, or indifferent. I don't care if a company reports good earnings, bad earnings, lower than expected earnings, better than expected earnings like GM. Look at the forecast, folks. You can't look at where we're at today. You have to look at where we're going. It's like anything. When you're driving your car, do you just look right in front of your car and you don't even look into the future or down the road? Of course not. You'd get in an accident. But if you're investing that way, if you're just looking just right down at the road, as close to the front of your car as you can see, what's going to happen next? You're going to crash. If you're a smart driver, you're looking down the road. You're looking for deer. You're looking for cars. You're observing things. It's almost subconsciously, how that happens with us driving. But I know, like race car drivers, they're trained to look through the turn, not at the turn, through the turn. Okay, so when you're investing, you need to look through the news. You need to look through current earnings. You need to see what's coming. And that's very easy to see. I mean, it's very easy to see. In the news the other day, there was an article. Now, we don't probably have that article. Maybe Stephen can find it. But the article talked about the cliff, the corporate debt cliff. So what is the corporate debt cliff? Well, any of you that own businesses, you know that over the last couple of years, debt, loans, home equity lines, lines of credit for businesses have been very easy to get. Up until recently, they've been very easy to get. Not only were they easy, they were freaking cheap. For the better part of the last 12 years, you could get low interest rate loans very easily. Money was abundant, especially after the pandemic, when the Fed decided that they were going to print $5.2 trillion. Now, remember, the Fed doesn't put the money into the system. The U.S. government does. So the Fed authorizes, controls monetary policy, but authorizes how much money is going to be printed. And then that money gets divvied up. Central banks get some, but they can't give you, the Fed can't give you money, but they can lend the money to the United States government, which they do at rapid and crazy amounts. I mean, just this fourth quarter, they're anticipating over $1 trillion that they're going to print for the government. And what is the government doing with it? Well, I don't know. You guys watch the news. I mean, what, 100 billion? What's 100 billion, right? We're just going to send that overseas, playing a dual proxy game here, which I simply can't understand, and I'm not even going to talk about. But really, the whole idea is there's this cliff coming, because all this cheap debt that all these companies absorbed and took on, EDIL loans, lines of credit. Listen, I'm guilty. I did the same thing. I took cheap debt. Why not? I've paid all of it back now, thank God. But a lot of businesses haven't, and now their maturities are all coming due. And in just the last couple of days, I've kind of called out how much those maturities are. And I'm going to get it wrong, but this year, I think it's like 528 billion of corporate debt is maturing. Next year, it's like 780 billion. I might be off by a couple, a couple 10 billion, no big deal. 700 and some billion maturing next year. But then after that, 1.1 trillion and then 1.2 trillion. But here's the thing you're not seeing. If you're looking at the front of your car, you're looking in your rearview mirror, you're not seeing this. And that is that the debt that matures is going to mature at a rate that is more than double what they're paying for now. So here's what I'm trying to paint the picture. And I got a graph that's going to show this. If all these corporations, which CEOs say that there's an 84% chance of a recession, if they're all frontline and they all know that this is coming, that's why they're so bearish on the markets. And that's why they're saying 84% chance of a recession, because they're the ones on the front lines. They're seeing it. The Fed's never going to give you a good thing. Economists, depends on who's paying them. So all the other indicators outside of consumers, you and I, and the CEOs of companies, we are sitting on the front line. You're going to the grocery store. You're seeing what's happening. You're looking at your bank statement. You're saying, hey, wait a second, guys. The income I'm making, even though it's more than what it was before the pandemic, isn't keeping up with inflation. I mean, hell, eggs went up 30%. Margarine's up like, I can't remember, 60% or something. Who's buying margarine anymore? Can please somebody explain that? But when these corporate debts mature, they're maturing at a time when things will be slower than they are today. Look through the corner. Look through the turn, as a race car driver does. The future is not bright and sunny. The future is not bullish. It is as bearish as it ever gets. You just got to look through it, and you got to see it coming. Right here, let me go one step further. In Instagram, I know this is backwards, but here, actually, let me take, because I don't have TikTok, so I can do some fun things with Instagram, and I'm going to show all of you. I want you to see this. Okay, what this is this is the Russell 2000. YouTube and Facebook, I'll show this in a second. This is a chart, okay, and this is called a triangle. So you can see this is the triangle here. So what it does is, chartists or economists, they'll take a pattern here that's the Russell 2000, and they'll basically chart it, and they'll kind of be able to they'll see through the turn by the trajectory of where the markets are going. Which, if you look at this, it's a narrowing pattern, which basically means, and sorry, I'm doing this with one hand because I'm showing Instagram what I'm talking about. It's narrowing, which the more it narrows, the less ups and downs we have. And what's very unique, this just happened, folks, just happened. And I'll read it here. Let me flip this over now that you guys have seen this, and now I'll just talk through it on Instagram. But also, folks, like, here it is. I mean, is that, Stephen, can you see that? Can you see?
No, not really. I mean, kind of.
It's kind of hard to see. The camera's not going to zoom in, but, it's just narrowing pattern. So it's like a chart, and it's just narrowing. But then all of a sudden, in October 3rd, what happened is the index, the Russell 2000, broke 1750. So forget about the numbers. Don't even worry about that. But it broke through. So if there's a channel, it broke through the downside. Okay, no big deal, because then it bounced back up. But then it immediately broke through again, like a few days later. Then it came back up into the channel, because this is what's called support and resistance, and you're testing the support or you're testing the resistance. So, and then it broke through a third time, and this was just October. Oh, this was yesterday, actually. October 23rd, it broke through, but it broke through big time. Like, it went way through. So there's a rule, 3 touches. If you're an options trader or a chartist, or you trade stocks on a regular basis, you understand support and resistance. And when you're testing a strong support or resistance level, the 3-strike rule is always what it is. Okay. So they call it a yo-yo. It hits 3 times and then it breaks. It either breaks down or it breaks up. Okay. So it breaks through, and forget about support and resistance. Think of it as a floor and a ceiling. Look down, that's your floor. Look up, that's your ceiling. Put a trampoline in the middle of your room and start jumping as hard as you can on the trampoline. You'll start hitting your head on the ceiling. Eventually, you'll break through the drywall and you'll be into the attic or whatever the next level is. And you keep jumping hard enough. Eventually, if you weigh enough, you'll go through the floor, right? Same idea. Stocks do this all the time. But what the Russell 2000 did in this triangle is it broke heavily through the 1750, which is a really strong support. So I want to just read this to you. He said, because how the Russell broke is even more interesting. This one is the oddest and funniest breaks I've ever seen. Now, this is an economist that writes this, something we subscribe to. Look at what happened since the index first broke 1750 on October 3rd. It yo-yoed up and down, took 3 breaks before finally heading down more clearly. This is rare. Such a large and obvious pattern normally would follow through in a clearer, more obvious fashion. In other words, follow that trend, getting narrower and narrower or widening out. It happens all the time. This one didn't. So what he is saying is, based on this breakthrough, the Russell 2000 isn't going to hold that 1750 line. It's not going to hold that front line of 1750, we're going to make new lows. That is not bullish. That is bearish. Bearish as it ever gets. He's predicting that it goes down to 1320. Now, whether it does or does not, that's irrelevant. But the markets are on crack right now, folks. They really are. I mean, future forecasts don't look good. If you look through the turn, it's not good. The corporate debt is going to fall off the cliff. But you know who's the biggest debt holder? Stephen, you know this. The U.S. government. The biggest debt holder of them all. And I can't remember the number, but a 3% move in the U.S. government's debt, if interest rates go up 3%, which clearly they did, they went up more than 3%. They went up almost 5%. Okay, so a 3% move in interest rates on the amount of debt that several days ago or even a week ago, the amount of debt the U.S. government had would increase their payments $1 trillion a month. Did you hear that? Just the interest rate impact on U.S. debt increases their monthly payment by $1 trillion. We're not talking about a couple $100 million. We're not talking about $1 billion. We're talking about $8 trillion. Just let that sink in. So what's going to happen? I don't know. I mean, there's so much going on, but let's get into some of the other things. I mean, Stephen, where should we go here? Should we talk about
on your point, I mean, I have a couple, kind of just things to pull up on that just to kind of keep it going a little bit. You're talking about Jamie Dimon, this came out yesterday. He was out in Saudi Arabia giving a speech, and he's basically just ripping the central banks, the Federal Reserve, saying they're 100% dead wrong on economic forecasts, and basically just warning on the dangers of locking in an outlook about the economy. He says, prepare for possibilities and probabilities, not calling one course of action, since I've never seen anyone actually call it right. Dimon added that he doesn't think it makes any difference whether the Fed hikes rates another quarter point or not. And just gets into a little bit, he said, I want to point out the central banks 18 months ago were 100% dead wrong. I would be quite cautious about what might happen next year, irregardless of what they're saying today. The comments reference back to the Fed outlook in early 2022 and for much of the previous year, when central bank officials insisted that inflation surge would be transitory. Along with the misdiagnosis on prices, Fed officials, according to projections released in March of 2022, collectively saw their key interest rate rising to just 2.8% by the end of 2023. It is now north of 5.25%, and core inflation at 2.8, 1.1 percentage points below its current level as measured by the central banks. So Dimon criticized this as omnipotent feeling that central banks and governments can manage through all this stuff. He said, I'm cautious, and just goes on. I don't think think it makes a piece of difference whether the rates go up another quarter basis point or more, like zero, none, nada. He's saying it doesn't matter what the central bank really does at this point. In other recent warnings, Dimon warned of a potential scenario in which the Fed funds rate could eclipse 7%. When the bank released its earnings report earlier this month, he cautioned this may be the most dangerous time the world has seen in decades. Whether the whole curve goes up 100 basis points, I would be prepared for it. I don't know if it's going to happen, but I would look at what we're seeing today, more like 70s, a lot of spending. A lot of this can be wasted. Elsewhere in finance, Dimon said he supports ESG principles, criticized government playing whack-a-mole. You can't build pipelines to reduce coal emissions, yada, yada. So just kind of repeating some of the stuff you were talking about there, Chris. And I mean, Jamie Dimon, is one of the what does he run, the largest fund by assets in the world, right?
Yeah.
And just a couple other interesting articles on what you were talking about with the corporate debt. I mean, this came out last month or a couple months ago, but $2 trillion corporate debt wall will spark job losses in 2024, according to Goldman Sachs. Goes on to say the bank estimates that the economy could shed $5,000 or 5,000 jobs per month in 2024 due to rising corporate debt. Companies will need to devote a greater share of their revenue to cover higher interest expenses as they refinance their debt at higher rates. And then just to show you kind of some of the other types of debt that we're dealing with right now. So this came out last week on Friday. Higher for longer rates will test corporate debt's maturity wall. So upcoming U.S. high yield bond and leveraged loan maturities. And you can just kind of see, not much over the next couple of years, but starting in 2025, that high yield bond and leveraged loan maturities really start to explode. And it just kind of shows, how this actually affects things. So the big picture, the lagging impact on the Fed's policy tightening is on full display in the corporate market, where much of the borrowing is fixed rate. Nearly everyone took advantage of easy money in 2020 and 2021 to refinance. As a result, there wasn't a ton of debt that needed to be addressed in the year and half since the Fed started raising rates. But the refinancing needs to really jump in 2025. That's the beginning of a big maturity wall. So that may seem a faraway away, but it's really not. Typically, companies address maturities at least 1 to 1.5 years in advance. If they don't, it's often a signal of trouble. So they're saying that wall in 2025 coming up, these companies are having to start address today, coming up in 2024 planning. So, what is that going to look like? Less spending for the company, to cover this debt, and how does that happen? So the next year will be vital for the class of 25 and 26 to prove they've got their balance sheets under control. Meanwhile, higher interest rates have already helped push up defaults. After sitting at usually low levels in 21, the default rate in the U.S. is now back in line with the historical average, according to Moody's. So how much higher it'll go as capital becomes harder to come by. So let's zoom back in. Take a company like Staples. The office supplies retailer has bonds due in early 2026 that it pays just 7.5% annual interest on. But these bonds traded at distressed levels, 82 cents on the dollar. So they're yielding nearly 17% right now. That's the market saying the bonds aren't refinanceable, at least not right now. And that's important right there, Chris.
Can I hit on that real quick? Go back up. So
yeah, go ahead.
I was an advisor for 16 years, and a lot of the portfolios we used to build and manage for 401ks, we had different portfolios we managed internally when I was at the RIA, and we always used high yield bonds. Now, pre-2008, I was an advisor, and almost every portfolio I had high yield bonds. Why? Because of exactly what Stephen just said. They paid a high yield. Like, it was just kind of silly. Like, people that needed income were like, oh, well, let's do high yield bonds. They're bonds. They're a little bit higher risk than, AAA or AA rated corporates, and definitely higher risk than treasuries, but like, we're getting paid for the risk. In 2008, folks, when the Great Recession hit, high yield corporate bonds got decimated. I mean, like 30+% losses, because you were playing with, and I didn't understand then what I understand now, you're playing with fire. So I want all of you to either call your advisors, look at your statements, look at all of your investments. And if you have anything that says high yield bond, you need to exit that. This is what's going to happen. You're going to repeat 2008 when it comes to high yield bonds. Actually, I think it's going to be way worse, because in 2008, the debt curve, like the debt cycle we were in, wasn't where we're at today. And not only that, it wasn't as big of an issue. We didn't have rising rates back then like we do today. So if you got anything high yield corporate, you need to get out. And the other thing I want to preface is, we have a couple of traders on here. I can tell just by the language being used. We've got Jim Collins, he's talking about trend lines, technical analysis, which is often used by traders, especially derivative traders. I would have to guess Amphone is a trader, because he's looking at GM. And earlier he said that the markets are bullish, which is right. If you're looking at the end of, right in front of your car, not looking down the road, yeah, the market's bullish. But then he makes a comment and he says GM is a buy. So let me just show my screen here real quick. And I want to, because listen, like, sometimes you got to understand how to articulate information. If you're a trader, GM might be a buy in the very short run. But if you're just an average person thinking, oh my God, I need to find a place to put my money that's safe. Oh, someone said GM's a buy. It's a buy if you're a trader, because you can technically draw the trend lines. You can look at where it's at. Just like, hey, the Russell 2000, you could anticipate that. And for options traders, based on that knowledge, and Jim was calling it the descending triangle, or ascending, it's whichever. You can basically trend that Russell 2000 is more than likely heading down, because we broke through a major level. And that means it's probably going to trend down. So you could buy puts on that and probably do well. But if you're not a trader and you're just the average person watching WTF or any of our shows, none of that stuff makes any sense. And I will tell you, if anybody bought GM for the long run thinking this is going to be a good investment, you're probably dead wrong. Let me just show my screen here. and I just want everybody to kind of comment on this, and I want everybody to tell me what they think. Let's see. Oh, great. And I'm not going to show any kind of a technical screen. I don't want to pull one of my accounts, but here it is. Like, I just did a Google search. Here's GM over the last year, over the last 5 years. So if you bought GM, let's just look at 5 years. If you had bought GM, how you doing? Like, let's just say you bought it, I don't know what this would be over here, 2019. You bought GM in 2019 thinking it's going to be a great buy. How you doing today? You actually have lost money. You lost money. Good play, right? You bought GM. You thought they were going to crush it in the electric car market. And how you doing today? Well, worse than you were back then. Let's see, 2806 versus 3265. You would have, now, if you were a technical trader, you could have bought, at many points, you could have bought here and sold up here. You could have leveraged that with options. But just look at where we're at here. So, Amphone is saying this is a buy at 2806. I'd like to ask, what basis are you coming up with that GM is a buy? Are you looking at fundamentals? Because if you're looking at fundamentals, there's no freaking way. Fundamentally, GM stock is pretty much a piece of shit. Okay, and the chart right there proves it. So fundamentally, as Warren Buffett would look at it, and again, I don't know all the fundamentals, but just basic stuff I know about GM is the company is not fundamentally in a good place. And the future outlook for GM is piss poor. GM, number one, with the strikes, as Drew mentioned earlier, but GM went all in on electric cars. How's that working for them? Electric cars are a loss, they're losing money on electric cars. In the future, that might be the future, but they're going too fast, too hard, and people don't want them. My buddy just bought, we'll go to Ford. My buddy just bought that Ford Lightning, I think is what they call it, that truck that was like the rave. He has had it 1 month, and he's already trading it back in. He's already actually probably by today, he's probably traded it back in. Why? Because the range was supposed to be 320 miles, and when he drives it with air conditioning on, he gets 180 miles. He's like, I can't drive this. I got a location. He's a business owner. I have a location in Rochester. I need to go back and forth. I don't have time to stop and charge. He's like, this isn't what I bought into. This isn't what I wanted. And he said, what's going to happen in the winter? I don't even want to know. So people paid major bucks for these GM Hummers that are the electric Hummers. I got 2 of them in my neighborhood. They're sweet looking truck. I'm not going to lie. But is it practical? Is that really the future of GM? And GM is not profitable on their electric cars. It's not. It's fact. So how is GM a good buy? If you're not a technical trader, if you're not a trader, how is GM a good long-term buy? So Amphone said, what about, we're about to repeat 2020, the C_V19. Not quite sure what you're saying there. You think the Fed's going to open up the printing press and start printing money? I think you're dead wrong there. Matter of fact, I'm not saying you're dead wrong, but Jerome Powell will tell you you're dead wrong. I think when we go into a recession, they'll come off of all their beating their chests, saying we're going to hold rates for longer. They're going to definitely drop rates, which is exactly why the main thing I talk about treasury bonds, because you want to talk about a buying opportunity, folks? Here, I'm just going to pull up, I'll just pull this while you guys are watching. Stephen, can you see this?
Yeah.
All right. So that is a buying opportunity. Okay. I'm not making a recommendation or giving financial advice. I own this. I have been buying this. So what is this? That's an ETF. I'm not showing you regular treasuries because this is just easier. It's an ETF. PIMCO 25-year 0 coupon, meaning I get no interest on this bond, treasury bond. Why would anyone buy this? Some people, a lot of advisors say that's a piece of shit. Why would you buy that? You don't even get paid for it. Look at the chart. 5-year. But let's really go into the 1 year. You see this? You know why that's gone down? It's not because fundamentally it is going down like GM. Do you know why this is going down? Because of the inverse relationship to interest rates. So based on what Amphone is, I think, trying to say is that we're about to repeat 2020 where they're going to pull rates again and drop rates down in a recession. I could be way off on that, Amphone. I'm just speculating there. But if the Fed drops rates in the next coming years because we enter a deep recession and unemployment numbers skyrocket, which is about to happen, if you just listen to what Stephen was talking about with the banks, there's mass layoffs. Geico's, just laid off. There's been layoffs, major layoffs in the tech space. So it's coming, folks. When all the companies start predicting there's a slowdown, what comes next? Layoffs. It's textbook. They should just teach this shit to 3rd graders because it's just textbook. It's so easy. So when they do that and pull rates in the next coming years, what will happen with this? Well, I don't know. You'd have to go back to, I don't think I even have the chart. Yeah, I do. No, I do not. Here, let me go to a different one, folks, because and a lot of you don't want to look at charts, and that's not what this show is about, but I'm trying to prove a point here. Here we go. 2008. What happened in 2008? The Great Recession, right? Nobody really saw it coming. Well, actually, some did, and there's a movie about it, The Big Short. There was a movie about that, but just look at what happened to these treasury bonds. Like, these are 20-plus year treasury bonds, not zero coupon, so they don't have as much of an upside when rates get pulled. But you can see what's happened here. I've been buying this thing all the way down. And just for the record, I'm down about 25% on this holding, which is a 20-plus year treasury bond. I'm down like 20-some%. But I just keep buying more and more as it goes lower because I don't know where the bottom is. And I'm not trying to time the market. I'm just dollar cost averaging in. But look at how steep that drop is, right? Why? Interest rates are going up, so the price of the bonds are going down. What happened over here when the interest rates went up? The price of bonds went down right here. Okay, when interest rates started going up, the price of the bonds went down. And then instantly, when the Fed dropped rates to close to zero back in 2008 to combat the recession, like they'll probably do again during this recession coming, look what happened to that. It spiked. So what do you think is going to happen next time? Look at what happened during the pandemic. It spiked. What happened during the pandemic? The Fed dropped rates to close to zero. Do you see the impact? Like, it's textbook. Inverse relationship to interest rates. Play the interest rate game. That is a buying opportunity. Okay, and you guys can do your research, talk to your advisors about it. But I'm just trying to prove a point. Like, I disagree with unless you're a trader. I don't mean, but we can disagree to agree. Amphone, I would never buy GM. I would never buy it. I think it's a dog shit company. I think they're going the wrong direction. I think they're not listening to their customers, and I think they're being led because of the government's initiatives. The new green plan, which I don't think is the Green New Deal. Sorry, I don't think it's called the Green New Deal. Actually, it is the Green New Deal. It's just called the Inflation Reduction Act. Yeah, because it reduced inflation. Anyway, what else is in the news, Stephen? What else can we hit? Here, actually, let me open this one up.
Yeah, good.
So there was an article I read, and I don't have it on me, and I apologize, Instagram, YouTube, and Facebook, but it's about oil. So we know that we were almost oil independent back in the last administration, and then now we're not, but we really are. Okay, so here's what I'm trying to paint a picture. So in the news right now, why Exxon and Chevron are doubling down on fossil fuel energy with big acquisitions. Right in the news. Here, Stephen, do you want to just share that for me?
Yeah.
So, you would probably ask, why would Exxon and Chevron double down on fossil fuels? Well, number one, because the price of oil is going up, and they know that. So they're doubling down, they're buying companies. But why would they do that when the government's fighting them? Well, the government sounds like they're fighting them because they're driving this green deal with electric cars and everything, which hurts oil. But it doesn't mean that Exxon and Chevron can't ship oil overseas, which is exactly what they're doing. There was a study in a report done that showed how much energy the United States of America uses. And then it showed how much oil and energy, including natural gas, the U.S. producers produce. We produce more than we use, which is the definition of oil or energy independence, right? In our country, we produce more energy than we actually use by a pretty large amount, not huge, but a large amount. So that's energy independent, right? Why would we need energy or oil from overseas? It's not that they can't get enough oil here. Okay, it's not that they can't drill enough oil, get enough natural gas. We have plenty of capacity here. The problem here isn't in the oil. The problem here is our need for what the oil is doesn't match what we can produce. So we can produce raw oil, which we then ship off. We sell it to India. We sell it to Europe. We sell it all over the country. And then what do we do? Or what do? They refine it. They refine it into what we actually need here in the country, which they refine it into cooking oils, and they refine it into gas for your cars and diesel, which is a huge one. We don't have enough refining capacity in this country. So what the government is doing, and all the stuff that you heard, is the government is basically making it almost impossible for these companies to want to invest, because it's very expensive, into refineries, so refineries can make the raw product into what we actually use in this country. That's the disconnect, folks. The permits and the costs and all the red tape and regulations that the companies like Exxon and Chevron have to go through in order to refine the crude and the raw product into what we actually use here. That's the miss. So we're not connecting. We have the supply, but we don't have the finished product capacity. So we ship it off to other countries. They refine it, and we buy it back at a probably pretty big markup. That's where the problem is. So Exxon and Chevron are doubling down on fossil fuels, but you know who's benefiting? Not us. That shit's going overseas. And then they're refining it and sending it back over here because our government can't just link the two together and say, hey, here's the problem. We can't refine this. So let's incentivize big oil. And most people are like, oh, don't do that. It's bad for the environment. Wake up. If that's what you think. Oh, it's bad for the environment. Wake up. We're shipping the oil. The oil's being made. It's being shipped overseas where someone else with probably worse refineries that are dirtier and worse for the economy, they're doing it over there with less regulations, polluting the earth. If we stop thinking about us, we stop thinking about me, the United States of America. We start thinking about the global impact. That's where the problem really is. What's going to change the ocean currents and result in a deep freeze? I know that's definitely speculation, but it would be not just what we do in the United States, but what's done worldwide. We're not solving any problems here. We're just trying to buy votes. We're trying to just make it seem like we're trying to make an impact, but that's not. The shit's going somewhere. It's going out of this country, which doesn't help employment numbers, doesn't help people, get paid more here, doesn't help Exxon and Chevron want to, open refineries, which then would hire more people, high-paying jobs here in the country. No. Let's just send it overseas where they can hire more people and they can become better, bigger first world countries just like we are. I don't know what you all think about that, but I think that's backwards. But that's the reality of what's actually going on. And it's right in the news. Right in the news. What else, Stephen? Do something fun.
All right, I'll go to something fun next. It's hard in the news. I mean, you know what they always say, like CNN, constantly negative news network, right? It's what draws us in and keeps us there. But I mean, along the lines of savings, we've talked a lot about that in past, just more and more stories coming out. This is, just one coming out today, this morning. Only 19% of Americans increased their emergency savings in 2023. That puts households in a bind, experts say. It's more of like one of those common sense things, right? But with inflation and higher interest rates taking a financial toll, fewer Americans put money in an emergency fund this year. Most financial pros recommend having at least 6 months worth of expenses set aside. And I can say, Chris, that we are seeing this in the real world right now, because on all of our webinars and shows that we do, I feel like we're getting that question almost every single day is, how much emergency funds should I have? Like, what should my savings look like? How should I store that? Like, where should that be stored? Should I keep that in cash in a safe? Should I keep it at a bank? Should I keep it in my specially designed banking policy? What does that look like? And, it seems like we're getting that every day. So it's definitely on people's minds. And it's a great question, really.
It really is. And the only answer I can say is it depends. Depends on you, your circumstances, just where you're at. Like, I have very little money in banks, but I will tell you, and it's me and my wife were literally just having this discussion last night, and probably because I've been talking about it a while. And, she was just asking, she's like, do we have, if things go to hell in a handbag, like, are we okay? And I said, absolutely. And I said, here's what we've been doing for the last many years. We've just been putting money in all these different places. Like, and here, I'll just name them off. I've got money in commercial banks, Key Bank. I got money in credit unions. I got money in community banks. I've got money in money market funds. I've got money in Charles Schwab invested in those two treasury bonds. I've got money in TD Trade, and TD Trade is where I'm really buying into these. I've got a couple high grade corporate bonds. I've got one muni, which I probably wish I didn't have, but I got to hang on to it. And then I got a whole bunch in those two that I just showed, and the VIX, because I think the market's going to go down. So I've been layering into the VIX, the volatility index, and then also I've got a shit ton of money in whole life insurance policies, specially designed whole life policies, like lots. I keep that money moving all times, but because I'm making my money go to work for me, that money's making interest. And that interest comes back to the same source, my private banking system, which is the whole life. So every single month I'm being replenished. So I make the money go out to work, okay, when I have it, and then it just comes right back. It's kind of just like, the Australian thing, you throw it and it comes back to you. What are those called?
Boomerang.
Boomerang. Oh my gosh. Can't believe I forgot that. See, forget all the fun things as a kid. Boomerang. My world, and every one of you that use the infinite banking concept, is a boomerang. You throw that shit as hard as you can. Go work. Get high. Go out there and do your thing. And what does it do? The thing always comes back to the same place if you know how to throw it. First, you got to learn how to throw the boomerang. But once you learn how to throw it, it always comes back. My money goes out like a boomerang and it always comes back. Sure, it comes back in smaller monthly amounts, but that replenishes the emergency fund. So there's always extra money there. And any of you using the infinite banking concept, it's the same thing. I always like to call the infinite banking concept Monopoly, because all of you have played Monopoly, right? You know how that works. Monopoly, you start with a certain amount of money and you all start on go. And then you go around the board and the goal is to pick up assets that produce income, right? That's the game. It's a real estate game. But then every single time you go around the board, you pass Park Place, you pass Boardwalk. What's next? You go past Go. And when you go past Go, what happens? You get money, $200. That's just like the policies, folks. Every year, no ifs, ands, or buts. You get a dividend. It's like pass and go. And then you go out and you make your money go to work for you that you just collected from pass and go every single year. And then that money buys more houses and apartments. And when people land on them, they got to pay. You know the game. Round and round we go. And the person that accumulates the most and has the most properties that pay income wins in a roundabout way. But that's infinite banking, folks. That's the boomerang. It's just a circle. I know Monopoly is a square, but same deal. The money always lands in the same place. But what you do with it is what matters. It's not the policy that makes you wealthy. It's what you do with the money after it hits the policy that makes you wealthy. That's the greatest piece of advice I can give everybody. So when people ask me, like, how much should I have? And I guess that depends. I would say 3 to 6 months is a good metric to use, but more for some. But if you've got money coming back because you've been recapturing all the money that you used to pay out to everybody else, then it's less. So that's a really good thing, and a lot of people bring that up. But
Yeah.
I can't think of anything better to be doing right now than the infinite banking concept. And for some of you that aren't doing it, like, you really need to learn it. It's not hard. It involves changing one thing and adding one step. It's the easiest thing in the world, but it's the hardest thing in the world as well, because it's a completely different way of thinking about how money works.
Yeah, I mean, here's a good comment from Jim over on YouTube. It says it's not just households, that are lacking the savings, but he said, many large REITs, it stands for real estate investment trusts, which are basically publicly traded real estate projects, don't have an emergency fund for when property values and rents occupancies fall. And Jim, we talk a lot about that, but in the private sector. So in the private sector, a REIT is essentially a syndication deal, or a private money raise outside of like a direct lending type of mortgage, where it's more of like a big fund for a deal put together. And one of the things that we warn people all the time, especially in these syndication deals, is be careful, because a lot of these syndications, they look right up front, but then the managers either don't know what they're doing, or they don't allow for market changes and conditions. And so what the plan that they thought they were going to have using the money that they raised ends up not working out right, and they need more money. And so the people that are in that syndication are the owners of it. Well, what happens there? Well, it either fails, or they all have to continue to put more and more money into it. And, I've been talking with a lot of fund managers lately, and it seems the most popular thing that people are really looking for right now are just straight debt funds. And I think one of the reasons for that is people are scared to speculate right now. And in syndications, these deals that are longer term, where you have higher upside equity potential for the back end and things like that, that's speculative. And people are worried about what the markets are doing right now. The cool thing about a debt fund or a direct lending deal using a mortgage are the terms are set up front. So it's very clear. You put in a certain amount of money, and you're going to get paid a certain amount of interest. Now, the principal, maybe they got to keep it longer if something goes wrong, or, the principal might be, but you're going to be getting that interest coming back in on a regular basis. And people are looking for that consistent, predictable return on their money right now. Very similar to what you're saying, Chris. Like, you're not as worried about putting your money out to work, because you're immediately going to have that money coming back in through these interest payments and through the recapture of it, as opposed to putting that money in one of these long-term deals where you don't know when you're going to get that money back, if any of it, and you're definitely not getting anything back on a regular basis. So I think that's the great comment that Jim made, and it really brings it together. And if what I'm saying right now is kind of like, well, how do I get involved in a private fund or these kinds of deals, direct lending? Like, where do you find these kinds of opportunities? Like, how do I know my situation? Like, where do I get the money to invest in stuff like that? we have a 3-day training coming up called Money School Essentials. It's our foundational training we've been doing for 3 or 4 years now. It's coming up. It's a live virtual training on November 3rd, 4th, and 5th. And that Friday, Saturday, and Sunday next weekend, that's exactly what we're going to do for 3 days, is we're going to lay out what that looks like for you, for all of you, to be able to go out there, where are the sources, how are you smart with your money, how do you take control of it, and then we'll introduce you to these different opportunities to do this stuff, that some of the things I was just mentioning, as well as a bunch more. So it's a great opportunity. If you want to learn more about all of this, join us for those 3 days, and it'll be a lot of fun.
Yeah, we'll toss the link for the 3-day with a discount code in the comments over here for YouTube and Facebook. And for Instagram, just watch my stories. I'm posting about it every single day, and I'll be posting about it, and you'll see it. But I want to go to a couple questions coming in here. Steve Baker, coming in from YouTube, asked a really good question, one that we've covered, I think, extensively. I'm almost kind of sick of talking about it because I feel like I've been talking about it for years. But he said, what is your understanding of the inverted yield curve and its historic correlation to economic recessions? So this is, again, one we've really covered a lot. We've covered it in our 3-day Money School Essentials extensively. We've covered it in wealth webinar trainings that we've done. And I've got lots of YouTube videos. So just go to @TheChrisNaugle on YouTube, and I've got lots of videos. Just type in inverted yield curve. So the inverted yield curve is essentially been tracked since the world wars, okay? And it has never been wrong, not once, okay? So all it basically is saying is the inverted yield curve, which right now we're not inverted, but we have been for the better part of over a year, okay? So essentially, the inverted yield curve is saying that you get paid more money for buying a 2 or a 10-year bond. You get a higher interest rate for buying a short-term bond from the government than you would get for buying a 30-year bond, right? Now that should make no sense. Just right out of the hole, you should be like, logically, like, that makes no sense. Why would I make more for buying a 2-year bond than I would for buying a 10? A 10 should pay me more because it's a longer time. There's more risk. There's more interest rate risk in a 10 or a 30-year than there is in a 2-year. So why would a 2-year pay me more? Therein lies the problem. When the yield curve inverts, which we were deeply inverted, Stephen, I think the first time we talked about the inverted yield curve might have been like the beginning of 2022, somewhere around there, or March of 2022. It was somewhere around there where we were all over it. I have all the charts, like, it inverted, and it popped out of the invert, and then it inverted again. I don't know how many times it's inverted since last year, but it's been a number of times. So that's never been wrong. Every single time the yield curve is inverted, it has led to a recessionary period. Every time. Maybe not a severe recession, but every time. So why this time would it be any different? But here's the thing. People think when the yield curve inverts, immediately following there's a recession. Wrong. It's like 6 to 9 months. It's a lagging indicator. And you can research all this. Just Google inverted yield curve effect. And there's all sorts of white papers and articles. You can learn a ton about it, or just watch our videos on YouTube, or come next week, I'll be talking about it. So what are my thoughts about that? Well, my thoughts are exactly what they are. I mean, it's if you look at the survey that I was talking about with CEOs saying 84% chance of a recession, the yield curve basically has 68% chance of a recession. But that's skewed as well. It's probably 100% chance if you look at history, because it's never not resulted in a recessionary period. So I think that's a really, really good question, Steve, and one that I love talking about. But again, sometimes I think a lot of people, like, they just don't understand it. So it's a bit high level, and it's easier if I just draw it out for people and show it. The other thing I want to hit on here is Chris R. had mentioned TD Ameritrade. He said, didn't Schwab buy them and move all the accounts over? Correct. Yes. But TD Ameritrade, if you log into your TD Ameritrade, it still looks like the old TD Ameritrade. If you log into your Schwab, it still looks like the regular Schwab. Yes, Schwab owns TD Ameritrade, but they're one and the same in terms of how they operate. Kind of like, when you look at Money Multiplier, the Money Multiplier, we call that mothership. Okay, that's the general agency. And then BYOB is a brand. And then there's a whole bunch of other brands. Cash Compound. There's, what is Jerry's brand, Stephen?
Wealth Dynamics.
Wealth Dynamics. So there's all these different brands underneath mothership. Well, Schwab is the same thing. Schwab's mothership. Schwab has its own brand, as Money Multiplier does. And underneath Schwab is TD Ameritrade and Thinkorswim and several other brands. That's how it's set up. So it doesn't change how it operates. Chris, you're saying that Schwab bought them and all the accounts moved over. Did your TD Ameritrade accounts become Schwab accounts? Like when you log into TD Ameritrade, does it actually show Schwab now? Because mine isn't. I just logged in this morning. I log in every day. They're just up on my dashboard, and I look at them both. So that's a good one. But yes, it was a merger, and they combined. So that's a good call. Let's see. This one's a good one, Stephen. John, coming in from YouTube, said, ever heard of Lafayette not letting somebody borrow their dividend? Well, let me rephrase your question, because that's not really the right way that I would understand it. But have I ever heard of Lafayette Life, which is one of the mutually owned insurance companies that we use for the infinite banking concept policies? Have I ever heard of them not letting somebody borrow money, like take a loan from their policy? The only time I've ever heard of them not letting somebody take a loan is when the client had no money in their cash value. Other than that, there'd be no reasons. Or there could be court-ordered things that would prevent loans from coming out. There could be fraud that would prevent loans from coming out. But for the most part, no. Or let somebody borrow their dividend. The dividend makes up the cash value once the dividend's declared. And as long as your dividend option is paid up additions, then you should have no issue. So maybe what you got to check, John, is just where are your dividends going? Are they going to reduce your premium? Are they just being paid in cash? Or are they going to paid up additions? If you want to be able to use them and borrow them and allow them to accumulate and get compounding interest, then you need to change your dividend option to paid up additions. So that all dividends buy more paid up additions, which increases the cash value and the death benefit. But Dave Ramsey says that when you die, you don't get your cash value, which blows my mind, because number one, it just tells me how misinformed he is, because he literally talks about paid up additions in the last couple of Dave Ramsey things. And this is in the news, so I'm kind of talking in line. And he says, when you die, the insurance company doesn't give you your cash value. No. He's correct there. The insurance company doesn't add the cash value to your death benefit. But if you follow your death benefit goes up every time your cash value goes up. Every time you get a dividend, your death benefit goes up. Every time your cash value increases from guaranteed interest, your death benefit goes up, because it's paid up additions. Paid up additions are buying micro little death benefit as time goes on. So effectively, are you getting your cash value? No. So I guess Dave's right there. But is your death benefit going up every time your cash value goes up? Yes, as long as the policy's built correctly. So Dave clearly doesn't know how to build a policy if that's what he's saying. Just be careful who you get your information from, folks. All right, what else do we got here? Lynn, I know, let's see, don't understand when I look at Schwab. Oh, that's good. I don't understand when I look at Schwab. Don't quite understand that. My TD Ameritrade did get swapped over. There was an email that migrate. Oh, okay. I didn't want to migrate mine. I like them being separate. But I like Schwab too. Schwab's a great platform. So whether it's Schwab or TD Ameritrade, they're both really good platforms. Yeah, mine hasn't. That's bizarre. I must not have clicked the button. So really interesting stuff. So we got a minute left. I want to hit one more thing in the news. Stephen, if you can pull this up. Adjustable rate mortgage demand hits highest level in nearly a year as interest rates continue to climb. Can you pull that one up?
Mm-hmm.
All right. Some of you that lived through the Great Recession should really be moved by this. Do you remember what one of the big things that kind of created issues in 2008? Right there. These ARMs and income valuations, or I'm not going to get into it, but like this, adjustable rate mortgages. I don't think this is a terrible thing right now, because we are in a higher interest rate cycle. But by people buying adjustable rate mortgages, or ARMs, which would be a component of adjustable rate mortgages, they're looking at like I said, they're not looking through the turn. They're looking at the front of their car. They're just trying to make something work today without looking at the long-term ramifications of what could happen. Now, if the Fed did continue to hold rates for longer, people will get screwed here. But I'd almost bet that right now people are doing adjustable rate mortgages. They'll probably reset or adjust down in the coming years. But I'm just simply stating, like, this should be alarming, because this is one of the main things that hurt us in the 2006 and 2007 run up to the Great Recession. I mean, these things, and the only reason you're seeing them come up and be more popular is because people can't afford the houses that they're buying. So the banks and the mortgage companies are literally constructing products that makes them be able to afford something they can't afford. Now, go back to your ancestors and your grandparents and just ask them, Grandpa, Grandma, did you guys buy a house you couldn't afford just because you could make the numbers work if you changed this, this, and this? No. Back then, they bought things they could afford. Today, we don't do that, which is why this country is rampant in debt, why credit card debts are record highs, why car loan debts are more than student loan debts. Like, this is the problem. People are buying things on emotions, and they're not paying attention to the long-term ramifications of what it is. What drives or hurts a family in a recession more than anything else? You guessed it, debt. This is a problem. And that's all I have to say about that, Stephen.
Perfect.
All right. So, folks.
And we stayed away from the war, and we stayed away.
No, we didn't. Stephen, play the video. You got to play the video that I gave you. I can't go. I'm sorry. I can't let this end without playing this video. Now, listen, like, I haven't fact checked this, so I don't know the relevance. TikTok would probably ban me again. So we're going to play a video that I saw, and I just want everybody's quick opinion on this video. I'm not even going to make a comment. I'm not even going to tell you my thoughts. I just want to know what you all think. Can you roll that video? And I'm going to let Instagram check this out too.
1 second. They did, just so you know, the White House did come out and admit they messed up, and this is definitely a true story. But
well, the dude doesn't even know what he says.
Wait, are you talking about the one you sent me this morning?
Dude is. I think everybody knows who the dude is. He doesn't even know what he says. Can't even walk. Barely can talk. Doesn't know.
Which video am I playing? Am I playing the wrong one?
The one I texted you this morning.
Okay. Tim Kennedy?
Delta Force. We'll play both. Let's play both. Delta Force. Yeah, this
one, right?
You know, Tim, the White House tweeted out this picture of Biden meeting with U.S. Special Forces. As Special Forces yourself, their faces weren't blurred out. What does that mean for them? Will they be able to work again? And how dangerous did that? How much danger did that put their families in or themselves in?
First, everybody that works within the government is human. We are fallible, all of us. And, you know, the men and women that are here on the ground are the most, I think, incredible men and women that I've ever had the opportunity to work with. Oh, you know, we're still human. We try our hardest. You know, that is a devastating mistake. Our identities, while you're working, especially as an operator undercover, like, you have to keep who you are protected and hidden. Those men are in jeopardy. Groups like Hamas and Hezbollah and ISIS-K, you know, Kamal al-Qaeda, all branches are looking for opportunities to take a face, get a name, figure out who their families are, and then start attacking those people. And Israel has been experiencing this for decades, and I hope we don't see that in the United States.
45
that is exactly
years.
Where it starts.
Tim, 45 years that this has never happened to Delta Force, and now it happens now.
Yeah, they're the most elite fighting force on the planet. Their OPSEC is second to none. Their professionalism, their experience, their capability, truly the most. I mean, if you walk next to those men, you're walking next to giants. And it's heartbreaking that men that have dedicated so much of their lives to this idea of service and being part of their country and being part of the Department of Defense and being part of the most elite special operations unit in the planet. No more so than that in the history of mankind. That's who these men are. And now they are vulnerable because of mistakes.
Right. Okay.
Wow.
I don't even want to say anything. So what does everybody think about that? Instagram, post your comments, YouTube, Facebook.
It just makes you wonder when, you know, at what point does incompetence become purposeful and criminal and needs actually, but wild times we live in right now, that's for sure.
Wild times.
I never thought I'd see. We'll save this for next week.
Yeah. Well, folks, we had to play that. I'm not going to make any comments on it, but the dude messed up. That's all I can say. The dude just keeps messing up, but yet no one's holding the dude accountable. With that being said, folks, thanks for joining us for another What the F Happened. We'll see you this afternoon for the Wealth Webinar, 1 p.m. See you then.